You ready for your last cluster, Cluster 9 of your Qualification National Certificate in Business Administration Services? You're well on your way to becoming the best administrator that you can be. In this cluster, we deal with basic invoicing and accounting principles, prepare and process documents for financial and banking processes, demonstrate an understanding of selected business environments, and apply basic business principles. So the overall purpose of any business is to supply needs and wants to a customer. They do this by supplying products and or service that fill the needs of the customers. The manufacturer manufactures the car, taxi, bus, furniture, cleaning materials, etc. The goods are then sold to the trader, where the customer can buy what he or she wants or needs. This is called trading stock. So the primary objective of any business is to make a profit. The manufacturer has a cost for manufacturing the good. Then they'll multiply that by a markup price, and that will be the selling price to the retailer. The retailer then calls that their cost price, and they then put on a markup, which becomes the selling price to the consumer. This selling price minus the expenses that it costs to acquire or to manufacture the product becomes the profit for the organization. The secondary objectives for organizations is the consistent provision of good quality products and services, create favorable working conditions for employees, and maintain good relationships with suppliers and or customers. Revenue is the amount of money a company actually receives during a specific period of time and includes discounts and deductions for returned goods. Interests earned on investments, dividends, profits on sales of fixed assets are also revenue. So we can safely say that income is only the monies received from trading, manufacturing, and or providing a service. Expenditure is what it costs a company to run on a daily basis. The telephone, internet services, maintenance of equipment, salaries, the rent, bonds, anything that needs to go out. Costs are divided into two different categories. Let's take a look at them. Fixed costs are those costs that are the same every month. They don't change proportionally to the manufacture and or running of a business. Things like rent, electricity, telephone charges, bonds, salaries, and are also known as overhead costs or indirect costs of an organization. Variable costs, on the other hand, are those costs that change according to the proportion of business expenditure, that changes in direct relation to the number of products manufactured, raw materials, purchased goods, stationery, etc. Both fixed and variable costs are different for different organizations and are dependent on types of products and or services that are offered. The sum of fixed and variable costs make up the total costs. For a training organization, maybe if you can use Trainingforce as an example, which is a service type organization, the total costs may be categorized as follows. We have administrative overheads, things like salaries, equipment, stationery, rent, lights and water, etc. Then we have marketing overheads, things like branding, designs, advertising is all part of marketing overheads. Then we get product development. That is the development of the training material, presentation media, the printing of training manuals, learner guides that you receive. And then we have services delivered, facilitators, assessors, moderators, consultants in the organization. So we can now safely say that the profit of an organization is thus the income from services rendered and or goods sold. The costs incurred to provide the service and or purchase the goods to sell. To determine a profit, the basic formula would be to calculate the cost price, add the profit markup, which will equal the selling price of the item and or service. Profit markup is determined by the market in which you're selling. So we can say that 25% would be the markup in this case. So if we look at our example, our manufactured goods cost 100 Rand, it's multiplied by 25%, and that then equals 125 Rand, which is then the selling price to the retailer. The retailer then adds his 25% or whatever percentage they have in the market, and that equals 156 Rand 25. Now, if we take the selling price of the manufacturer and the one of the retailer, and we minus each expenses, we then get profit for each. Now that we have a very good idea of how an organization works and the cycles in which they work, let's take a look at the main ideas that we learned throughout this topic. Income is the monies received for goods and or services sold and or manufactured. Revenue is the total sum of money owed to the organization. Expenditure is the money that the organization spends to run the concern. Fixed costs are costs that don't change monthly. Variable costs are costs that change from month to month. Total costs is the sum of variable and fixed costs. Profit is the amount of money the organization makes after expenses have been deducted.